I'm very highly confident that we're going to see $3,000 gold, and next year we'll probably see $4,000 gold, and 2001 and 2009 after bubbles had burst. And so we haven't even had any kind of an economic accident, and U.S. spending is out of control. And so to me, that's the real driver behind the gold price, the knowledge. If you look at silver on a technical basis, if you're into looking at charts, you can see this enormous cup with a handle, and we're right on the cusp of breaking out at 3250-ish or so. We break through that, I mean, we're going to squirt up to 40 very, very quickly. And I think realistically, I mean, it's odd to me that silver's never topped its 2011 and Hunt Brothers highs of $50. I mean, I think we're going to blow through 50 and head to 75 or 100 in the next few years. And
gold prices have experienced a remarkable surge of approximately 32% since the beginning of 2024, significantly outpacing the S&P 500's 23% and the Nasdaq's 28% increases. This impressive performance can be primarily attributed to growing expectations of lower interest rates from the Federal Reserve. Historically, declining interest rates have correlated with rising gold prices, as lower rates reduce the opportunity cost of holding non-yielding assets like gold, making them more attractive to investors. Additionally, there has been a notable increase in gold purchases by central banks worldwide, particularly in China, which is looking to lessen its reliance on the US dollar. Over the past 2 years, central bank purchases of gold have consistently surpassed 1,000 tons annually, a historic benchmark that underscores gold's enduring status as a safe haven asset amid growing economic uncertainty. Heightened concerns regarding the fiscal health of the United States have further intensified interest in gold as a protective investment. A recent report disclosed an August budget deficit of $380 billion, significantly exceeding initial expectations by $90 billion. This alarming level of deficit spending raises critical questions about the long-term sustainability of U.S. fiscal policy, particularly as the country currently operates at a deficit equivalent to 6% of its GDP. Such elevated deficit levels typically indicate economic downturns rather than periods of growth, prompting investors to adopt a more cautious approach in their financial strategies. Lawrence Lepard expresses optimism about gold, predicting prices could soar to between $3,000 and $4,000 within the next year. He points out that the Federal Reserve's recent 50 basis point rate cut marks the beginning of a new cycle aimed at managing the costs associated with federal debt. While some analysts contend that the Federal Reserve has successfully controlled inflation and restored a deflationary environment, gold prices continue to reach record highs. This ongoing increase underscores a disconnect between market sentiment and broader macroeconomic indicators. Such divergence suggests that many investors are bracing for potential economic challenges, further enhancing gold's appeal as a hedge against uncertainty. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
What I think is going on is, yes, you got the Asian demand, and you're finally starting to see U.S. ETF demand. That number is slowly curling up, meaning the U.S. retail investor is coming back to gold. A couple things I think, like really what's in my mind, what's going on is it's becoming very clear to a larger segment of the world, in the BRICS countries and in the Western world, that the U.S. is fiscally trapped. And I remember one of the recent bumps in the gold price took place it was a few weeks back now, but it took place right after the U.S. announced its August budget deficit. And I think in the month of August, the U.S. had a $380 billion deficit, and the expectation was for a $290 billion deficit. So we were $90 billion more than what the consensus expectation was. These things are lumpy, so you can't take the 380 and multiply times 12 and come out with a $4.8 billion deficit. The reported deficit for this year ended September. I think the final hasn't come out yet. I think it's going to be 1.819, maybe 2. But the point is that this kind of spending on the part of the U.S. and then the lack of any belief that it's going to stop or get better has really driven the gold market, I think, to understand that monetary debasement is just an absolute certainty. Even though the Fed has been strict, was strict for a few years, we've now seen them start to change that. They did their first cut and it was 50 basis points. You can argue whether that was right or wrong. It doesn't matter. They did it. We're in a rate cutting cycle. And frankly, they had to be in that cycle. They have to do that. I think, they're pretending inflation's under control. And maybe it is, maybe it's not. I don't think it is, but they're trying to jawbone that it is. And with that, with that belief, that gives them the freedom to bring the short rates down. And they really need to do that because the federal interest expense is just blowing out these deficits. I mean, it's very unusual for a country to run a 6% GDP deficit when the economy is ostensibly healthy. I mean, those are the kind of deficits that we ran, or we ran slightly larger, but in 2000 and 2009, 2001 and 2009 after bubbles had burst. And so we haven't even had any kind of an economic accident, and U.S. spending is out of control. And so to me, that's the real driver behind the gold price. The knowledge, the construction of the political situation in the United States is such that we cannot stop. You had a debate recently, and there were no questions, there were no comments, there was no talk, there's no discussion of this. It's as though Washington is completely oblivious to it, and they're just ignoring it. And my suspicion is they'll kind of continue to try to ignore it until something breaks, until they can no longer ignore it. As they cut rates, and ultimately they did bring the quantitative tightening from 60 billion down to 25 per month. I think they'll eventually stop that. And then ultimately they'll have to cut rates more. And then ultimately I think we'll be back in a QE environment. The answer to the question I posed is because gold can smell what's coming next. So, and that's why I'm very highly confident that we're going to see $3,000 gold, and next year we'll probably see $4,000 gold. And we are in another gold bull market. I mean, we had one from, 2018, went from 1360 area up to 2000 with all the COVID printing, 2070. And then, we got tight, and Jay Powell tried to be Paul Volcker, who he's not. But he did raise rates, and that slowed down the growth of M2, and that shows up on the M2 chart. But as you can see now, if you look at a global M2 chart, it's growing again. China helps out, but even US M2 is growing. So we're going to be back into a money printing environment, in my opinion, in the next year or two, and gold smells that. And if you look at these bull markets, I mean, like in the 70s, gold went from 35 to 800. That was 22x. From 2000 to 2011, it went from 260 to 1700. That was 8 or 9x. If you count the beginning of this gold bull market as 2015 at 1,050-ish, okay, so we're at, 2,600. So we've done 2.6x, but 2.6 is not the same as 9 or 20. So I think we have much higher, if this is a gold bull market, as I think it is because of the fiscal situation, I think we're going to see much higher gold prices in the next 3 years.
In a dramatic turn of events, the silver market has experienced a significant breakout, potentially signaling the start of a long-awaited bull run. This sudden movement in silver prices has captured the attention of investors and analysts alike, suggesting a pivotal shift in market dynamics. Technically, silver is positioned for a breakout, with a critical resistance level set at approximately $32.50. Analysts believe that if this key level is surpassed, it could trigger a swift ascent in prices, pushing them toward the $40 mark shortly. Lawrence Lepard emphasizes that silver's historical highs, previously peaking at $50, are now within reach, heightening investor interest. He argues for even higher targets, with projections indicating that prices could soar to $75 or even $100 in the coming years, driven by increasing industrial demand, particularly in sectors like renewable energy. Moreover, the Federal Reserve's recent rate cuts signal the onset of an easing cycle, further bolstering the bullish outlook for precious metals. Lepard acknowledges that while current market sentiment may lean toward caution, numerous opportunities are emerging for savvy investors. He predicts that gold and silver prices will rise dramatically as economic conditions evolve, fostering renewed confidence among market participants.
I'm one of the really excited about silver ones. I mean, as you know, these are both monetary metals, and they have value because the money is being debased. So that makes the price of both of them go up. The beautiful thing about silver is it's a monetary metal, but it's also an industrial metal that really has a lot of use cases, right? And so if you look at the projected increases in solar demand in China and really throughout the world, it's going to soak up all the silver we're producing. Excuse me. You've also got this new solid-state battery technology that's come out of Toshiba, which arguably is said to be able to, give a car, 900 miles worth of range and recharge in nine minutes, but requires a boatload of silver to build. And I've seen projections that suggest that if these batteries catch on, and this is obviously several years out, that's going to increase the demand for silver. And then if you look at silver on a technical basis, if you're into looking at charts, you can see this enormous cup with a handle, and we're right on the cusp of breaking out at 3250-ish or so. We break through that, I mean, we're going to squirt up to 40 very, very quickly. And I think in realistically, I mean, it's odd to me that silver's never topped its 2011 and Hunt Brothers highs of $50. I mean, I think we're going to blow through 50 and head to 75 or 100 in the next few years. And the thing about that's so exciting is that you've got a number of silver miners who have ASIC costs in the $16 to $22 range, and so at $30 they do fine, they make some money. But boy, do the math at 40, 50, 60, 70. I mean, it gets just crazy. And some of them are selling at modest multiples of today's earnings, and so flex the earnings with a higher metal price and then expand the multiple of that higher metal price. I mean, you're going to have some, not a few, you're going to have a large number of silver companies that do 10 baggers or more. So I'm like the others that you've probably spoken to. I'm incredibly bullish on silver, and we are overweight silver in the portfolio. Add to that is, the clues on all of this, in my view, that are very important to watch are, the U.S. bond market, the U.S. dollar, the price of gold, the price of silver, and the price of Bitcoin. I mean, these are all the signposts that tell you what's going on in currency land, what's going on in macro currency land. And one thing I'll point out that I think is very meaningful and interesting is that Powell just cut the basis, the Fed funds rate 50 basis points, and the yield on the 10-year has gone straight up. And so in a rate cutting environment, traditionally people would think, okay, rate cutting environment, that implies recession coming, that implies, lower inflation, that implies longer bonds are okay buy because, we're going to have a less inflationary world going forward. So, you would buy the 10-year going into a recession and a rate cutting environment. And yet that's not what's happening. The 10-year is actually going up. And I think the reason it's going up is it smells the coming inflation. And so, again, all the things that I see point to, much more of an emerging market kind of set of market conditions at a macro level. And the U.S. is behaving, in a fiscal sense, the U.S. is behaving extremely irresponsibly. And has been able to do it because for X number of years, we've been the reserve currency, and there's a lot of built up trust in the U.S. But I think what you've seen, starting with the taking away, the Russian reserves and behavior on the part of the BRICS and countries trading in their own currencies for commodities, I think what you've seen is that facade is getting broken apart, and people are beginning to really doubt that the U.S. is as secure a currency and as secure a set of financial markets as has historically been the place.
In recent months, gold has established itself as the best performing asset in the precious metals sector, with prices soaring nearly 34% this year, reigniting investor interest as a safe haven amid economic uncertainties. While short-term volatility may continue, market sentiment remains bullish, with analysts forecasting further price increases driven by geopolitical tensions and inflation concerns. Meanwhile, silver is gaining attention for 2025, as experts predict a significant supply surplus that, combined with consistently high demand, could lead to substantial price growth, making it an appealing investment opportunity. How are recent trends in gold and silver prices expected to influence investor strategies in the coming years? Please share your thoughts in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.